Good afternoon, Mr. Ryan. How you doing today, sir?
Hey, what's happening, Mike? How are you?
Doing well. Another day here. So today, I think it's important that we talk about what's going on in the media with the LLPAs, right? And I'll let you touch on that in a moment. But first of all, what is it? And then what are we seeing in the media? What's the story that's trying to be painted out there right now?
Yeah, so the reason this video is important for you and I to kind of throw together is because we're getting DMs, we're getting texts, we're getting emails, we're having phone calls with people who are kind of either mad or happy about some changes that they saw on all the social media sites, right? Like
Yep.
TikTok, Reels, YouTube Shorts, this thing's kind of everywhere. And it started with some articles that were ran in the news
Yep.
that basically said borrowers who have bad credit are getting a massive break or an incentive to buy housing. And if you have good credit, you're paying more. It was
Yeah.
kind of left at that. Like good credit, you're going to get hosed. Bad credit, you're getting a deal,
Yep.
right? And people are going nuts over it. So if you have good credit, you're super offended. Like, how could they do that? Why are they going to charge me more? Should I tank my credit score now to get these deals, the incentives that are being offered to lower FICO scores? And
Yeah.
so we're having to deal with that. And then we got the lower FICO crowd that's like, yeah, let's do it. It's our time. We're ready.
Yeah.
And so it's important to kind of understand what all of this actually is. It's something that's been around for a long time, and I'll go into detail on it. But
Yeah.
that to kind of frame it up, that's the stuff that we're about to talk about is just what actually is it? Are you actually paying a lot more? Are you getting a deal? Is there an incentive, to having low credit? Let's go over that in detail.
For sure. Okay. So, like you said, the loan payment structure or the fee structure has existed forever, or at least as long as you and I have been in the business, right? And so this is not something new that's being imposed, really, right? It's just a change to an existing system, right? Okay.
Yeah, so the short of it is it's called an LLPA.
Mm-hmm.
What that stands for is loan level price adjuster.
Yep.
And look, it only applies to conventional loans. This is Fannie Mae
Mm-hmm.
and Freddie Mac conventional financing. This is not for VA. This is not for FHA. It's not for USDA. It's not for jumbo, right? And there's
Yep.
other conventional loans that they don't get sold to Fannie and Freddie. This is just loans that are sold to Fannie and Freddie, which in the industry we call that the agency, right? So it's
Yep.
the FHFA. They're the governing body for the agencies,
Mm-hmm.
which is Fannie Mae and Freddie Mac.
Yep.
Every year they look at their chart. They have a little chart
Mm-hmm.
that's designed to calculate risk. And that risk is designed, it's kind of framed around credit scores, and
Mm-hmm.
they tier it every 20 points. It's designed around down payments or equity position if it's a refinance.
Yep.
The down payments are every 5% for the down.
Yep.
And so if you imagine this chart would be like, 5% down and a 639 to 620 credit score. You follow it down, boom, it brings you to this little box, and that tells you the fee
Mm-hmm.
for that specific loan. So if you had a 780 and you had the same 5% down and you take the 780 and you come over here, that fee is significantly less than the fee that's going to be down here if you had a 639 to 620 credit score, the same down payment.
So the fee is what the borrower is being charged in order to get the prevailing interest rate, correct?
Correct.
Okay.
Yeah.
So if they've got a
that
lower credit
620,
score, they're
630.
paying more to get the best rate.
Right, exactly. So all things being equal, let's just say an interest rate is 6%.
Yep.
The person with the 780 with 5% down really didn't have very much in the way of adjustments. So
Mm-hmm.
they get the 6%, but they don't have any fees. They're not having to pay points or anything like that.
Yep.
But the person that has a 620 to 639, they want that same interest rate. It's going to make their payment better.
Yep.
So FHFA or Fannie Mae, Freddie Mac are going to look, you go down that chart, and prior to this change, it was 3.5 points.
Okay.
So on a $300,000 loan, it's over 10 grand that they would have to pay
Mm-hmm.
for the same exact interest rate, same loan
Yep.
as the person that has 780. The only difference is credit score. It's
Yep.
risk. So that chart has been around literally forever, and it changes all the time. Like
Yep.
not frequently, but usually on an annual basis, they'll meet up and they kind of take a look at all their data and they say, hey, we need to promote some more home ownership here. We have a little bit of a gap, or we need to kind of we see some risk here. We're gonna make this area a little bit more expensive.
Yeah.
And so they're always adjusting that. So this recent change that came out happened to be that kind of in the middle of the chart, 720-ish range, maybe 20% down. That fee went up a little bit. So the
Okay.
fee's about 0.75% higher than it was before.
Okay.
And so the media took that and went, whoa, you're going to charge somebody with good credit, 720 and 20% down. You're going to charge them more money than somebody who has bad credit. Not necessarily. What happened is they improved how much they were going to charge. They reduced the amount of the extra fees for that lower FICO bucket.
Yep.
And so they're still getting charged more than the person that has a 720 and 20% down. They're just not getting charged as much as they were prior to this change.
Correct.
Right. So is that, are you following there on that part of it?
Yeah, I totally get it. So,
yeah.
And again, this is not a new program. It was a change, probably an annual change that goes with every program on the risk assessment of this chart and where people fall in on it. And based on the data, they've said that the people with the lower credit scores and the lower down payment amounts in recent history, in the data that they have, they're not as risky as the people maybe in the middle with more down and a middle credit score. And so so they adjusted their fees. So the people that they deemed to be less risky than they used to be, their fee to get the prevailing interest rate is lower than it was, but it's still higher than the people with the really good credit scores, right? And then the people in the middle over the last segment of data have shown to be more risky than the outliers on either side of the scale. And so their cost to get the prevailing interest rate went up a little bit. Is that right?
Yeah, for the most part, I would say, the people that, the question I get is, should I somehow tank my credit score, right? This is what I get from people that have really high credit scores.
No.
Let's call it 700 plus or 680 plus. Let's just be fair and say 680 plus.
Yep.
Should I do something negative? Should I crank up my credit card and drop my credit score down a little bit to get this better deal? And the answer is no. The higher your credit score, you still are getting a better deal on your loan. It's still cheaper to borrow that money and you have less in the way of adjustments.
Yep.
But really what changed is that lower FICO range was almost out of the windows, right?
Mm-hmm.
So 620 credit score with like 3 to 5% down, most of the time, we're going to take that person FHA because that loan is going to be significantly better priced. It doesn't have all these extra fees and hits to it and versus conventional. So they're just not finding a lot of buyers in that conventional bucket. Now they've reduced that cost down. Maybe it's worth entertaining a conventional loan or at least comparing conventional for somebody that fits there versus FHA, which usually is a little bit more friendly. So all they're doing is trying to kind of re-promote maybe some of those lower cost range. It's not just a 620 to 640. There's improvements all the way around the board, including you have a 780 and you put 3% down, you actually got a little bit of a break on this whole deal too.
For sure. So real quick, back to that now. So the lower down payment amount and the lower credit score, we used to take those to FHA because it was a cheaper out-of-pocket expense for the buyer for the most part, right? And conventional wasn't getting a lot of those loans, right?
Right.
And now it's more appealing it could be more appealing for a buyer to go conventional instead of FHA now that $10,000 fee on a $300,000 purchase, if you're in that bottom of the graph, is significantly less. It's gonna be like $6-7 grand, right? But so there's that. Not even, let's not say benefit, but it's better. It's an improvement on the conventional loan that way. But also the conventional loans, you start off with PMI, right? And with FHA you do, but with FHA it's life of the loan, right?
Yeah, so the PMI is also tiered. So remember, if you're not doing 20% down on a conventional loan, there is a form of PMI somewhere, right?
Yeah.
We might advertise it as a no PMI loan, but in reality, maybe there's a one-time fee that we're buying out the monthly, right? So there's no monthly. Typically, if you have low down payment and it doesn't matter where your credit score is, if you're just doing low down payment conventional, you're going to have your monthly PMI. That's what you're going to kind of live with. Depending on where your credit score is, that fee for the PMI changes. Now, FHA is the same across the board. So let's say you have a 780 or you have a 580, you pay the same PMI fee on an FHA loan. If you put less than 10% down, that PMI is on there as long as you have that loan. If you pay off the loan, you can refinance. Maybe you don't need the PMI anymore, just got good equity, or you want to change up the loan in some fashion to a conventional loan. A PMI may just completely go away, but on FHA with 10% or less on the down payment, it's on there for what they call the life of loan.
Mm-hmm.
If you do 10% from day one, that PMI automatically falls off at the 10-year mark,
okay,
assuming you're making your payments on time. So there's some catches in there.
Well, and that your equity level is right.
Yeah, so really FHA is a PMI based loan. So if you think about it, somebody had a 50% down payment, but maybe they have a 620 credit score, they're going to have a PMI factor.
Yep.
Okay. It's not like it goes away. There's always going to be PMI. It potentially could come off in 10 years. But usually if we're focused on FHA versus conventional, it's because sometimes the interest rate on an FHA or the fee structure is significantly less than what it would be on conventional. And actually sometimes the FHA loan is approved and the conventional loan isn't, because conventional is reading the risk. If the credit score is
Yep.
low and the DTI is high and there's not a lot of reserve or whatever the
Yeah.
case is, it may say, hey, that's too risky. FHA is like, yeah, come on over, we're good.
Yeah.
So there's still reasons to kind of look at both.
For sure, but it's kind of leveled that playing field out a little more than it was, right? And I think that that's conventional's way of trying to entice more people to go that route with financing and for them to sell more product and make more money, right? That's the way that I'm seeing this, and why they would make that change and why they would try to incentivize the lower end, even though it's not incentivizing them at all. And right, it's costing them less than it used to cost them. It's not an incentive. It's not like they're getting a tax credit because they had a low score and that's free money. This isn't free money. It's just a less expensive loan.
Yeah, I mean, look, they're just promoting homeownership, and so they're giving a shot at some people that maybe just had some dings along the way, and
Yep.
and even you have really good credit, and you have just maybe you're getting started, and you don't have a lot down, you're getting a little bit of a break on this whole deal too, so it's
Yeah.
actually making that more affordable. There's another one for first-time buyers where you've got a program called Home Ready from Fannie Mae, for example. That program gets rid of all these little LLPAs we're talking about, these adjusters, these extra fees.
Yep.
Puts them all at zero. And so it gives you the same pricing as somebody who had a 780 credit score with 40% down as a first-time buyer, as long as you kind of meet the criteria.
Yeah.
You get that same interest rate as somebody that put 40% down with a 780, even though maybe you're at 660 and you have 3% down. You're getting a really good term on that. So there's other aspects of Fannie Mae and Freddie Mac that they've done all this for a long time. But what happened is the media took it as, hey, you got good credit, you're getting toast.
Yeah.
And you got bad credit, you better get in line because you're getting a good deal right now, which is just some truth to the bad credit part is it made it cheaper to get in the door. But on the good credit side of things, these are adjustments, these are cost structures that have been here for a long time.
For sure.
Also goes into effect May 1st. And so what happens May 1st is in the mortgage business, those are loans that are delivered to Fannie Mae and Freddie Mac on May 1st. It doesn't mean hurry up and apply today.
No, it's too late.
Right before May 1st, I'm good. And after May 1st, I'm toast. It means I have to have closed that loan, packaged it, had Fannie Mae review it, and sign off on it before May 1st. If it goes after May 1st, any of these adjustments, they're going to go into effect. Maybe there's a credit, maybe there's a cost, but the mortgage industry has to react to that.
So essentially, those are loans that closed in March. Yeah,
they put this in play for a long time. All the loans that were locked in April had all these changes already built in. All the loans, well, not all of them, but most of them that were locked in March probably had these built in because there's really about a 60-day runway from the time when we close a loan to delivering it to Fannie Freddie, get them to sign off on it. And we need to do that before May 1st.
For sure.
And here's the other thing. This was supposed to go into effect the start of the year. It was delayed. They decided, you know what, we're going to delay it. Let's push it to May. May rolls around. Now everybody's up in arms. Oh my gosh, it's going to cause, it's such havoc in the mortgage business.
Yeah.
It's been around for a long time. It's just, again, minor adjustments.
Yeah.
But there are some benefits. Maybe your credit's not perfect. That's a good time to kind of take advantage of it and see what you can do.
For sure.
First time buyer, that Home Ready program is fantastic. It's been around for a while, and that one's a really good one to look at.
Yep.
If you're putting a big down payment, your credit score is such that these new brackets are going to cost you a little bit more.
Yeah.
Sometimes we'll have you put a little bit less down and then get the lower cost and use that lower cost to offset the potential mortgage insurance, and you actually end up with a better deal putting less money down versus the additional money. So in the heat map that we use, we're kind of looking like, where's the sweet spot? Oh, shoot, this borrower, it's going to cost them significantly more. Let's move them up or down to better position them to just make their financing a little bit more affordable. And that includes sometimes you're off a couple points on your credit. Maybe I find a little tweak and we adjust it while you're in your pre-approval stage to push you up a tier to avoid some extra costs. So
to pay your credit card down a little bit, down below like a third or something.
Sure.
Something easy.
Stuff we've always looked at that. It's just now there's more awareness on the consumer side of what this actually is. So giving you a little peek behind the wizard's curtain, this is something we've looked at for a long time.
Yep.
It's the reason why we suggest certain loans over other ones, because hey, it's going to cost you significantly more here. Let's move you away from that. Let's focus on this. This is a better fit for you. This is just one example of why that happens.
For sure. And so I think, the next thing I was going to ask, we've already really addressed is, what impact is this going to have on our local market? And for us, I don't think it's going to, because these are things that, again, they've always existed. We've always known about them. We've always taken them into consideration and when giving people advice. And so really, I don't think it's going to impact our market at all, if I'm being honest. It might help the person who's at the bottom of the category. Again, it may be helpful to them, because one thing I don't think we talked about is typically the people that have the lower credit score and are doing the lower down payment amount, they're probably choosing that lower down payment amount because that's all the money they have, right? They don't have an excess of cash, but they're choosing to put as little down as possible, right? So if that $10,000 fee got reduced, it makes it easier for them to, in the spirit of promoting home ownership. So outside of that, I don't think it's really going to have an impact on our market at all. Do you? Is there anything that you're seeing that you're kind of like, well, let's look down the road on this and see how it goes?
I think there's two things that potentially happen. So unfortunately, because media is the media and they like to kind of have something to talk about to promote their brand, right? Remember, media is a business. So
it's entertainment now.
Stuff, right? We get ads, we can pay our payroll, we have all that stuff that exists. So we have to create buzz and we have to get people to share it and all that stuff. So they do a good job of that. Great marketing. So because of that, because it's spread, and you and I aren't going to talk to millions of people about this. I mean, unfortunately, it'd be great to, but we're not going to be able to. You're going to have a perception that, hey, higher credit score, it's going to cost a little bit. They may pause a little bit, where the lower credit score is going to go, hey, we got some wind behind our back. Let's move forward. So they'll probably balance each other out a little bit. I do know the majority of the inquiries that I've gotten around that have been from the lower FICO crowd that are looking at, hey, I just got a deal, tell me more about it. That's actually a good thing. It's getting them re-engaged. They felt a little down and out recently. So
for sure,
it's getting them kind of re-engaged. So I think it's a good thing. And the other thing is too, so in this call, we used the example of, hey, this 10K fee. So it's, most of the time, the consumer never sees that. The majority of the time, we actually build that into the rate. So instead of a 6% rate, maybe we take a 7% interest rate because there's a $10,000 incentive to the bank to offer 7% versus 6%. We use that incentive to pay that fee. So a lot of times, lower credit score, you're going to start off with a higher interest rate because we're trying to bury that additional cost. We're not going to come to the table and go, here's your loan, and gosh, here's all your cost, and I know you don't have the money in the bank because you barely put the down payment together. It's pointless. Like, we don't have room for it. So so anybody listening, don't take it like, oh my gosh, there's $10,000 in fee.
No.
The reality is, it probably is. It's just you're probably not going to feel it because you're not even going to see where it's at. We're probably
the fee
away from you.
The fee is only to get the prevailing interest rate. It's not just a loan fee. It's just a
competitive, lowest online rate you can find, just like you see all the time. That one's going to cost you a bit more if you're not in the perfect spot.
Exactly. So it's not a new fee. It's a fee that always existed, and it's a fee that you don't have to incur. If you don't need the best interest rate available, and that's not new. Like you said, that's something that we've always been doing. And you watch the heat map on the graph and say, okay, here's the sweet spot, and tell the client, like, if you do this, this is how it'll work for you. And that might be different than what your original plan was, but you, the client, get to make the decision. Like it didn't change. So I don't think it's going to make an impact on our market, but I don't see any negative.
There's not a negative impact.
No.
If anything, there's a positive impact. I mean,
it's going to encourage.
We've had people that are rushing to the scene because they want to get ahead of these changes, or we've got people that are re-engaging because they've heard these changes are going to benefit them. So it's, again, the buzz around it is misinformation. But the buzz around it's actually really positive just for homeownership anyways. So it's good.
It's serving the purpose of promoting homeownership. It just stinks that we still can't rely on media to tell the truth, I guess, you know.
It's a story, right? You have this big story and you have a snippet, and that little snippet is being told. And if you only see this little bit, it looks really, really bad.
Yeah.
Right? It'd be like if you were at you saw some friends at dinner and they were having a conversation about a couple that were fighting, but you only saw them in the heat of that. You didn't know they were reenacting something they saw. You just think that they're fighting.
Yeah.
So then you take it to the world and go, oh my gosh, I saw these people, they're totally fighting, they're getting broken up.
Yeah.
No, like you don't know the whole context around that. Like they weren't fighting at all. They were telling a story about these people. So that's what happens sometimes in the media. They go, oh, this looks good. Let's clip it here and clip it here, because I think that right there will get a lot of traction and it'll spread our brand, right? So we're going to push it out. So that's what happened.
For sure. Alrighty, sir. Anything else we want to touch on this before we go?
You know what, as we're moving into kind of the summer time, it feels that way, right? It's starting to get a little warmer out.
Yeah, it's 90 today.
And look, in our world, even if you don't go outside, you can tell it's almost summer because we're starting to see the multiple offers coming back. So just giving people kind of a heads up on that.
Yeah. Well, inventory's low.
We've been saying it for months. There's going to be a gap where it's going to be a little slower. You got a little more time. Now your pace as a buyer, has to increase a little bit because there's a little more in the way of activity.
Yeah.
And we're absolutely seeing that right now, and it's only April.
I looked, I think it was yesterday or the day before, I just checked, the system. I said, okay, what homes are available from Roseman to Agua Dulce? You want to take a guess at how many homes?
Like not in escrow?
Active.
327. I don't know.
That's a good guess. It was 386.
Okay, there you go. Yeah, I figured it was low. I went low because I felt like that would be where it was headed.
Yeah, and so to put that in perspective for everybody else that doesn't live and breathe this every day, back in 2006, when it was just the most insane, high-paced, time in that market, we got down to 800, right? And this 380, like I'll have to check. I don't think we got below 300 even during COVID. Even when we were at like 7 days on market, everything was flying. I don't know that we got below 300. We got down to just below 1 month supply, but I still think that was right about where we're at. I'll double check, but it's crazy. Like you said, the multiple offers are back. It's because there's nothing on the market, and this is prime moving time. So,
yeah, if you're going to make a move, look, if here's the thing, we talk about home ownership all the time. Like it's good. If you want to do it, go out and buy. Like we strongly believe it would be still a good time to buy if you're a homeowner.
Yes.
I want to talk to the sellers for just a second.
Yeah.
If the home does not fit your need, if you're considering selling, this market absolutely 110% needs your home.
Needs.
If you're on the fence with anything, like this is probably the best time in the world to sell your house, because there's an active audience right now that desperately needs your home.
Yes.
And, this is the story we're going to tell here for the foreseeable future, this low inventory kind of mantra.
Yeah.
It's going to be around for a while. Like, we're not going to solve it just overnight. It's not like half of the valley is going to decide to sell their home and we're flooded with inventory.
No.
But, it'd be a miss for any of us in this industry to go, let's keep promoting first-time buyers, let's keep promoting buyers. Like, we technically don't need more of you. We need more of you as a seller. We need more of you that's going to put your home on the market so another family can come in and enjoy it, and get to move up or move out of state, whatever the case is.
Yeah, for sure. No, we need homes desperately. I mean, like I said, at the peak of this market, when we got below 1 month supply, like we're still right there as far as the low number of homes for sale. Right. And we're below half of what it was in the last market. Like we need homes desperately. So again, like Ryan was saying, if there's anything about your house that you don't like if you're in a 2-story and you're getting older and you only want a 1-story, we need that 2-story home to sell for sure. If you have a pool and you don't want to pay for it anymore, we need a pool home to sell. Like we need homes to sell. And there are people that are looking to buy homes, even though the media tells you that the market is terrible and it's going to crash and interest rates are insane and affordability is the lowest it's ever been. Like they tell you all the negatives, but also incomes are probably the highest they've ever been. And our demand after lockdown is for sure the highest it's ever been. The market, especially locally, we are doing phenomenally. You know, there may be parts of the country that aren't doing well, that are maybe backsliding a little bit, but that's not us. Like
Yeah,
we are
there's
doing
definitely
well.
some markets that kind of went maybe just a little too hot and they had to kind of roll off that price a little bit. But
Phoenix.
they're still busy markets, but they're not, you know, 20-30% appreciation per year clip. That's insane. They had to come off that a little bit, which is totally fine. But look, local, we desperately need, you know, sellers to step up and sell homes. And I would encourage people that one of the biggest things is, I got this really low rate. I don't want to give it up. I'm going to hold on to it till death, right? Like it's in the 2s and the 3s. I'm never giving that thing up because I want to move into something higher.
Yep.
I would challenge that because I've seen more and more people that have a really low mortgage rate and they are stacked somewhere else, right?
Yeah.
Credit cards are at a pace that, you know, it's growing really rapidly and the interest rates on those are really high. And so you might on one hand go, hey, I've got a mortgage, you know, 2.5%. But if you look at an advisor goes, actually the total cost of your debt is 6.5%.
Because you get credit cards at 20.
Because you've got auto, credit card, all these other things, right? So you have to look at your household is if you're a business. I'm borrowing I have a cheap rate here on this line of credit and I have more expensive on this, but my total cost for the household or the business is X.
Yep.
So one benefit to moving up, moving down, whatever the case is you get to reset all of that. And a lot of times, you know, as a seller, you have a great equity position. It does not all have to roll into the new home.
For sure.
If you're working with an advisor to identify, what do I pay off? What do I stack? Do I supercharge, you know, some kind of a retirement plan that I'm underfunded, and still be able to move up and into that whole home for the same outgoing as I have right now? That move right there will trump the low interest rate and the savings you have in that low interest rate in the long run. So
for sure.
A good review on that is really, really important. We've made some really cool strategic moves with people where we're like, do this, stack some cash here, put less down here, move into this. Total outgoing is about $300 cheaper than you have right now. And you're going to have a couple $100,000 more when you go to retire and you have no debt.
For sure.
You got to make one payment instead of 15.
Yep. Yeah, and it's easier.
Those moves are awesome. It's such a change and it's literally right under their nose. They just don't see it. They're not trained to look for it. So
for sure. Alrighty, sir. We are out of time.
cool.
Thank you so much. Hopefully this is helpful to you guys. If you have any questions, reach out to us and we'll post in the comments or in the link the little heat graph that we keep talking about, just so you can see that and see the changes. But if you guys need anything, feel free to reach out. You can call, text, email, message, show up at our doorstep, whatever is best for you guys.
Perfect.
All right.
Thanks, guys.
All right. Take care.